Have you felt like you've got whiplash just from looking at the market lately? One day it's up, the next it's way down. Well, you're not alone. The entire market is obsessed with one thing right now: volatility. So what's really going on behind all this chaos? Let's get into it. And look, this isn't just a gut feeling. It's not in your head. There are some really powerful, interconnected forces at play here. And just understanding what they are is the absolute first step to navigating all this craziness with a clear head. And here's the most important thing to get right away. This isn't about one single scary headline. Nope. What we're seeing is more like a perfect storm of a few different pressures all hitting the market at the exact same time. Okay, so first things first, let's get the lay of the land. What does this market on edge actually look like? Well, you can see the instability is pretty much everywhere. Global markets are jittery, the US is seeing these huge swings within the same day, and Asia's a mixed bag. But the real tell, this smoking gun, is that last point: capital flows. Money is moving into more defensive positions. That's a huge signal that investors are getting nervous and running for cover. So what's making everybody so nervous? Let's play detective here and start with our first set of clues: the big picture macroeconomic pressures that are really setting the stage for all of this. Our first big clue is all about interest rates. The entire market is basically holding its breath, just sitting on the edge of its seat, waiting to see what the central banks are going to do about inflation. That uncertainty, all by itself, is a massive driver of the volatility we're all feeling. So here's how that chain reaction works. For a while there, the market was really hoping for interest rate cuts. But now there's this growing fear that those cuts are going to be delayed. And when that idea of rates staying higher for longer starts to take hold, it really puts the squeeze on growth and tech stocks first. This creates a massive tug of war inside the major indexes, pulling everything in opposite directions and just cranking the volatility up to 11. Now, it's not just about interest rates. There's another huge factor: that constant drumbeat of uncertainty around politics and policy. And if there's one thing markets hate more than guaranteed bad news, it's not knowing what's coming around the corner. Think about it. Every single new headline about tariffs or trade deals causes this knee-jerk reaction. You see money just flooding in or out of the market in an instant, and then that rapid movement gets amplified by algorithmic trading. We're talking computers reacting in microseconds, which can turn a little ripple into a tidal wave. Okay, so we've got these big external pressures. But what about the internal plumbing of the market itself? Sometimes how the market works is just as important as why it moves. Our next clue involves two heavyweights: the US dollar and government bond yields. These are the big dogs. When these two start moving around unpredictably, they don't just make waves, they create massive ripple effects that touch every other kind of investment out there. And here's how that ripple effect actually plays out. First, bond yields get all jumpy. That volatility forces investors to completely rethink, or as the pros say, reprice, how much risk they're willing to take with stocks. And the result? You see capital literally rotating out of riskier equities and into places people see as safe havens, like bonds, gold, and silver. And for our final clue, we've got to look at the market's own chart. This one is kind of like an inside job. Sometimes the market's own structure, just where prices have been before, can act like a tripwire, making the moves way, way sharper. This is exactly why a small drop can suddenly feel like a waterfall. A lot of the major indexes are hovering right near these really important technical levels. When they hit these zones, it can trigger a whole cascade of automated selling. Think about things like stop-loss orders. Those are just preset instructions to sell if a price drops. Well, when trading algorithms trigger thousands of those at once, a little dip turns into a sudden, severe nosedive. All right, let's recap. We've looked at all the clues. We have fear about interest rates, we have policy uncertainty, we have capital rotating around, and these technical tripwires. So what does it all add up to? Let's put this puzzle together. Look, if you take only one thing away today, let it be this: what we are seeing is not a systemic crash, okay? Instead, it's a rational, even if it's painful, market-wide process of just reevaluating risk based on all this new information. It's a course correction, not a catastrophe. So what does this whole repricing thing actually look like in the real world? Well, you've got your long-term investors who are mostly just hanging out on the sidelines, waiting for the dust to settle. At the exact same time, you have short-term traders jumping on every piece of news, and that's what's creating these huge swings. It means that for right now, sentiment and emotion are in the driver's seat, way more than company fundamentals. So understanding the why is absolutely crucial. But now, let's get to the important part. What does all this actually mean for you? Let's talk about a practical framework for how to think about this choppy environment. The main takeaway here is just one word: discipline. This is absolutely not the time to panic and sell everything, but it's also not the time to go chasing a monster rally one day or try to blindly guess where the bottom is the next. Why? Because all those underlying pressures we just talked about, they haven't gone away. The name of the game right now is patience. So how will we know when the storm might be passing? You're going to want to watch 3 key signals. First, the VIX. It's often called the market's fear index. Is it still climbing? Second, look at treasury yields. Are they just volatile, or are they becoming truly disorderly? And finally, here's a huge sign of a bottom. When bad news comes out and the market barely moves, that's when you know all the negativity is already priced in. And that brings us to our final thought. The entire market, from top to bottom, is fundamentally reevaluating risk. And that leaves all of us with a really powerful question to think about for ourselves. In a market that's busy repricing risk, how will you reprice your strategy?